Hello everyone and welcome to today's Mondaq webinar in association with MK Fintech partners, who will be exploring the complexities of the ever-evolving European Union crypto regulatory framework. My name is Dan Sampaio and I'm joined by a brilliant panel to take us through today's discussion. Justine Herrera founded MK Fintech Partners in 2018. Her background includes working at a criminal law firm, an international bank, and a leading global investment firm. For 5 years, Justine has been the managing partner at MK Fintech. Justine doubled company revenues in her second year of launching MK Fintech and obtained a virtual financial assets agent license from the Malta Financial Services Authority for the company. Justine's academic background includes an LLB and an LLD from the University of Malta and an LLM from the University of Groningen. Justine also received certification for a capital markets course at the Malta Stock Exchange and a course on virtual financial assets from the Malta Institute of Management. Justine used to form part of Malta's digital task force set up by the government of Malta and also currently sits as an executive committee member of the Virtual Financial Assets Unit, which is part of the Malta Chamber of Commerce. Kelly Fenech has a prolific background in financial services, distributed ledger technology, fintech and capital markets, with a special focus on investment, VFA and payment services, anti-money laundering and financial instruments. His career path yielded crucial experience in assisting clients in corporate and commercial matters, particularly corporate governance, M&A transactions and general company law. Furthermore, Dr. Fenech specializes in the issuing of legal opinions structuring fintech products, specifically crypto assets, to ensure they aren't classified as financial instruments, assisting clients apply for financial VFA services licenses, and advising on various regulatory matters to ensure firms remain compliant with EU legislation and MFSA and FIAU requirements. Now, before I hand over to the panel to begin today's webinar, a housekeeping item. You can submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page, and we'll endeavour to answer as many of those questions during our Q&A session. It's now my pleasure to hand you over to Justine and Kelly to begin. Thank you.
Perfect. Thanks so much, Dan. If you can go to the first slide, please. So firstly, good afternoon, everybody, and thank you for logging in to listen to our session covering the markets in crypto assets regulation. As Dan said, feel free to drop any questions you'd like to pose during our session, and we'll try and respond to them at the end of the hour. We'll leave 10 minutes or so for Q&A. So by now, most of you have heard or read all about MiCA, but for those of you who perhaps aren't as familiar, in short, MiCAR is a regulation regulating markets in crypto assets. So before MiCA came about, there was a lot of fragmentation throughout Europe in how member states regulated cryptocurrencies, with most member states just implementing AML or KYC registration. So the only two jurisdictions who implemented and had proper licensing regimes, which is very similar to MiCA and was actually very much based on MiFID, before MiCA came into force, are Malta and France. So in terms of what is the effect and what is the outcome of the MiCA regulation, the scope and the outcome of MiCA is harmonization throughout all of the European member states. And this to ensure one single level playing field and also to apply the same passporting rules which are applied to other industries such as investment services and financial services throughout Europe. In terms of who MiCA applies to, on the one hand, we have crypto asset service providers, so the same market participants you find in financial markets, such as introducers, brokers, custodians, market makers, exchanges, etc. However, instead of providing services related to financial instruments, they are providing services related to crypto assets. So on one hand, you have the CASPS. So if I say CASPS, it is a crypto asset service provider. And on the other hand, we have issuers. So the regulation divides crypto assets into three categories: electronic money tokens, asset reference tokens, which are both forms of stable coins and which will be defined and explained further by my colleague Kelly in the next few slides, And also the third category are crypto assets other than EMTs and ARTs, which I will also delve into after Kelly covers stablecoins. So the regulation covers these two participants. In terms of DeFi, is DeFi covered? Is it excluded from MiCA? MiCAR generally distinguishes between partially decentralized and fully decentralized when it comes to DeFi. There is one famous recital 22 of MiCAR, and this states that the regulation should apply to natural and legal persons and certain undertakings and to crypto asset services provided or controlled directly or indirectly by them. So here, the main relevant feature is the application to natural or legal persons. The recital also states that where services are provided in a fully decentralized manner, so without any intermediary, they should not fall within the scope of this regulation. So here we don't have so much information, and there is room for interpretation. I believe that it is important to really analyze each DeFi project or each DeFi protocol, because if there is a level of control, for example, by voting rights in terms of the assets at the governance layer, then they could fall within a scope of this regulation. So it is a bit of a gray area in terms of what is decentralized and not. So one really needs to assess the decentralized protocol and understand if there is a legal or natural person behind it, and if there is an element of centralization within the decentralization, specifically at the voting layer. So we could say DeFi is out of scope. However, if there's an element of centralization, then it could fall within scope. Now, when will all this kick off, or has this already kicked off? As you probably know, MiCA has been approved by the EU Parliament in June 2023, and in June 2024, the rules on EMTs and ARTs, so stable coins, will become applicable. And in December 2024, the rules for CASPS will apply. There are also various regulatory technical standards known as RTSs, which are all expected to be complete by the end of the year. So by complete, we mean that they have gone through the various layers. So first they're issued for consultation, then there's feedback, and then eventually they are published. So I believe 2 of the 3 RTSs have been issued and closed for public consultation, and we're waiting for the publication of those 2, and also for the consultation period of the 3rd RTS. These are obviously very important because they explain the nitty-gritty of certain provisions throughout the regulation. I will also delve into the transitional periods which may apply a bit later on in the presentation. I will now hand over the floor to my colleague Kelly to explain the different categories of crypto assets, and specifically EMTs and ARTs, and then I will go in to explain the utility tokens. Kel, over to you.
Thank you, Justine. Hello, everybody. Well, before we give a technical breakdown of EMTs, we must first define what a crypto asset is. So MiCA defines crypto assets as digital representations of value or rights that can be electronically transferred and stored using distributed ledger technology or comparable technology. Now, that definition is further subdivided into 3 groupings. So MiCA categorizes crypto assets into 3 groups, being asset reference tokens, electronic money tokens, and other crypto assets. Now, asset reference tokens under MiCA are defined as a crypto asset that is not an electronic money token and that purports to maintain a stable value by referencing another value or right or a combination thereof, including 1 or more official currencies. I will delve into further depth on asset reference tokens in the next chapter. So for the time being, I'll leave you with that definition. An electronic money token under MiCA is defined as a type of crypto asset that purports to maintain a stable value by referencing the value of 1 official currency. And before I move on to the next slide, explaining electronic money tokens in further detail, I just want to distinguish it from other crypto assets. So the term other crypto assets includes all crypto assets, often referred to as payment or investment tokens, such as Bitcoin, Ethereum, or Ripple, along with utility tokens defined under MiCA as a type of crypto asset intended solely to provide access to a good or service supplied by its issuer. One must know that this term does not cover ARTs, asset reference tokens, or electronic money tokens, financial instruments under MiFID II, deposits, including structured deposits, funds, life or non-life insurance products, and non-fungible tokens that are unique. And lastly, digital currencies, which are known as CBDCs. These are issued by the European Central Bank and digital assets issued by national central banks. So, moving on to the next slide. Could an e-money token be regarded as electronic money? So, MiCA acknowledges that the role of an electronic money token closely aligns with that of electronic money, as defined in the Electronic Money Directive. So first off, let's define what is electronic money. Under the second Electronic Money Directive, electronic money is defined to be electronically including magnetically stored monetary value as represented by a claim on the issuer, which is issued on receipt of funds for the purpose of making payment transactions, and which is accepted by a natural or legal person other than the electronic money issuer. The Electronic Money Directive, as indicated by Recital 8, also encompasses that the definition of electronic money should be wide enough to avoid hampering technological innovation and to cover not only all the electronic money products available today in the market, but also those products which could be developed in the future. So as you can see, the Electronic Money Directive provided quite a broad definition to ensure that technological innovation is not impeded and can accommodate current and future electronic money products, including potential electronic money tokens. So you will see now that electronic money tokens share resemblances with conventional electronic money, as outlined in the Electronic Money Directive. Similar to electronic money, these crypto assets serve as digital substitutes for physical coins, banknotes, and are intended for use in making payments. So under the Electronic Money Directive, an electronic money token will be considered as electronic money if it meets the definition I provided previously, and also if it satisfies the below criteria. 1, it has to be electronically stored. 2, it has a monetary value. 3, and this is most importantly, it represents a claim on the issuer, is issued upon receipt of funds, is issued to make payment transactions, and is accepted by persons other than the issuer. So, by contrast, some crypto assets today, stablecoins, when they reference an official currency, they do not provide holders with a claim against the issuer, nor do they provide a claim at par value with the currency they are referencing, or they limit the redemption period. So the fact that holders of such crypto assets do not have a claim against the issuer of such crypto assets, or that such claim is not at par value with the currency those crypto assets are referencing could undermine the confidence of holders of those crypto assets. This is why under MiCA, it states, accordingly, to avoid circumvention of the rules laid down in the Electronic Money Directive, any definition of an electronic money token under MiCA should be as wide as possible to capture all types of crypto assets referencing a single official currency. So what did MiCA do here? This is important to home in on. Previously, stablecoins were being issued and they left out an important criteria. They didn't allow for a claim against the issuer, or they did not guarantee a redemption, or they weren't issued at par. So even though they were very akin to electronic money, they didn't exactly meet the criteria. What MiCA wanted to do is to avoid circumvention of the regulation. So it simply stated that anyone who references an official currency will be considered to be electronic money. And if they are considered to be electronic money, then they must meet all the criteria of electronic money, which I had mentioned previously: the claim on the issuer, monetary value, issued upon receipts of funds, electronically stored. So this way there won't be any circumvention of EU regulations. Therefore, what we can conclude is electronic money tokens are considered as electronic money, but not all electronic money are electronic money tokens, because obviously not all electronic money is stored using distributed ledger technology. The Electronic Money Directive, being a directive within the European Union that establishes a legal framework for electronic money institutions, and MiCA, the regulation designed to govern markets for crypto assets in the European Union, intersect when an electronic money token is classified as e-money. Can you please move to the next slide? So what happens when an electronic money issuer issues crypto assets and/or electronic money? Firstly, who can be an electronic money issuer? Either a credit institution authorized under the EU Capital Requirements Directive, or an electronic money institution authorized under the second Electronic Money Directive of the EU. The electronic money institution and credit institution would not require additional authorization under MiCA to offer crypto asset services, specifically in relation to electronic money tokens. The only time the issuance of electronic money tokens would not require credit institution or electronic money license would be for offerings addressed solely to qualified investors, and offerings where the average outstanding value of electronic money tokens does not exceed 5 million, or the equivalent amount in another official currency calculated over a period of 12 months. An EMI solely issuing electronic money would have to abide by the Electronic Money Directive, which specifically addresses the regulation and supervision of electronic money. However, an EMI issuing electronic money tokens and e-money, or just electronic money tokens, would have to abide by both the Electronic Money Directive and MiCA, which specifically addresses the regulation and supervision of electronic money tokens. So, electronic money token issuers must handle funds from token sales this way. They must keep at least 30% in separate bank accounts and invest the rest in low-risk assets in the same currency as the token. They must also publish a white paper, and they should make this white paper available on their website. The white paper should contain all information concerning the issuer, the electronic money token, and the offer of electronic money tokens, or their admission to trading that enables prospective buyers to make an informed purchase decision and understand the risks relating to the offer of electronic money tokens. A description of the issuer, the issuer's project, and an indication whether the electronic money tokens are offered to the public and/or admitted on the trading platform. And a description of the underlying technology and standards of the electronic money tokens, the risks relating to the issuer, and a detailed description of the rights and obligations attached to the EMTs, including the redemption right at par value. So, the next thing is EMTs may be designated as significant based on the fulfillment of any three of the following prescribed criteria. Next slide, please, Dan. Aaron. No, we're not there yet. So for now, I'll just explain them to you. So there are three criteria which would make an electronic money issuance deemed as significant. And some of these criteria are the following. The size of the client base of the electronic money token is greater than 10 million. The value of the electronic money token issued, its market capitalization, or the size of the reserve of assets of the issuer of the money tokens exceed 5 billion. The average number and average aggregate value of transactions in electronic money tokens per day during the relevant period is higher than 2.5 million transactions and 5 billion respectively. The interconnectedness of the electronic money tokens or its issuers within the financial system, the importance of the activities of the issuer of the electronic money token on an international scale, including the use of the electronic money token for payments and remittances. So if they are deemed to be from that criteria, if the issuer meets 3 of them, then they would be deemed to be a significant electronic money token issuer, and more rigid requirements would need to be followed. Some of these would be, but not limited to, a duty to assess and monitor liquidity needs to meet potential redemption requests. Thus, issuers of significant electronic money tokens must establish, maintain, and implement a liquidity management policy and procedures, conduct liquidity stress testing on a regular basis, and most importantly, increase the average amount of reserve assets to 3%. They need to adopt a remuneration policy that promotes sound and effective risk management, and a duty on issuers to ensure that the electronic money tokens can be held in custody by different crypto asset service providers authorized for providing custody and administration of crypto assets on behalf of clients. This is obviously done to limit and diversify the risk. I think we can move on now to our next slide with respect to asset reference tokens. Exactly. So what is an asset reference token? As previously explained, Article 3.6 of MiCA defines an asset reference token as a type of crypto asset that is not an electronic money token. So, guys, try remember as much as possible. An electronic money token is defined because it references one official currency. That is the essential criteria. So, if a type of crypto asset, if an asset reference token isn't an electronic money token, then it definitely cannot reference against one official currency. It must prepare to maintain a stable value by referencing another value or right or a combination of the two. And this could include one or more official currencies, one or several commodities, or one or more crypto assets or a combination of such assets. Thus, one can easily note the distinction between electronic money tokens and asset reference tokens is based on the type of assets they reference. E-money tokens, once again I repeat, are limited to referencing a single fiat currency, while asset reference tokens have the flexibility to refer to a wider range of assets, including basket of goods, commodities, other crypto assets, or a combination of assets, of such assets along with fiat currencies. Can you move to the next slide, please, Aaron? So, authorization requirements and exemptions. So, the first is firms issuing asset reference tokens must be incorporated and licensed under MiCA within the territory of the EU. So, in order for the issuer of asset reference tokens to be licensed within the EU under MiCA, the issuer must be a legal person or undertaking established in the EU that has obtained a license by the competent authority, or already licensed, or an already licensed credit institution. So a bank, or they have to specifically apply for a license within the member state from where they intend to issue the ARTs, the asset reference token. Therefore, non-EU entities issuing asset reference tokens currently in the EU should act now to establish a company in an EU member state and obtain a license, given that the authorization process is time-consuming. Moving on to the next slide, exemptions. So the rules stated in the previous slide on who can issue ARTs will not apply in these cases. If the offer to the public of ART If the offer to the public of asset reference tokens is addressed solely to and can only be held by qualified investors. So this is similar to the exemption for electronic money tokens. Or the average outstanding value of issued asset reference tokens does not exceed 5 million or the equivalent in another official currency over a 12-month period. Next slide, please. So what are the other considerations? So what about the authorization process for asset reference tokens? Well, the authorization procedure entails a thorough examination of the application submitted by the issuer to the regulatory body. This process includes scrutinizing various aspects such as information pertaining to the issuer, a detailed operational plan outlining the adopted business model, a white paper for the crypto asset, governance structures, and various policies and procedures, such as a business continuity policy, internal control mechanisms, risk management policies, and safeguarding data procedures. What about the white paper? The white paper is mandated to include a clear and unequivocal statement that the asset reference token may experience partial or complete loss of value, may not always be transferable or liquid, and is not covered by investor compensation schemes and deposit guarantee schemes. Additionally, the white paper is required to encompass all pertinent details regarding the issuer, the asset reference token itself, and the offering of asset reference tokens or their approval for trading, along with information about the associated rights, obligations, underlying technology, risk, reserves of assets, and the significant adverse impacts on the climate and other environment-related issues. I think the next is what about the reserve of assets? So all asset reference tokens need to have a reserve of assets. This is essential. The reserve of assets must be distinct from both the issuer's assets and the reserve of assets associated with other asset reference tokens. Furthermore, those issuing asset reference tokens are required to create and uphold an asset reserve continuously. The structure and administration of this reserve should aptly alleviate the risks associated with the assets to which the asset reference tokens are linked and manage the liquidity risks arising from the ongoing redemption rights exercised by token holders. So there must be liquidity management procedures in place, because if the asset reference tokens are going to make reference to specific, you could say, illiquid commodities or not as liquid, there need to be procedures in place which would allow token holders to redeem without issue. There's also the own funds requirement besides a reserve of assets, and issuers of asset reference tokens are required to have their own funds equal to an amount of at least the highest of the following: 350,000 euros, 2% of the average amount of the reserve of assets, or a quarter of the fixed overheads of the preceding year. I think we can move to the next slide. So over here, what happens if an asset reference token is deemed significant? So I already went through these. These were meant to be copied. These were meant to be listed in the previous slide on electronic money tokens. That's why they were meant to be there. But we don't have to go through them again because I already elaborated on these points. So we can move to the next slide. What's deemed significant is the same for an asset reference token and for an electronic money token. So you can move to the next slide, please. Next slide. So what are the consequences of previous slide. What are the consequences of an asset reference token being classified as significant? Well, over here, there's a list. And, the list is similar to what I read out for the electronic money tokens, which are deemed significant. What I'd like to highlight is the main consequence will be that the issuer of an art will have to comply with additional obligations, obviously related to remuneration policy, monitoring of liquidity needs, and to hold an average amount of reserves of at least 3%. I think that's quite a brief on the electronic money tokens and asset reference tokens. Over to you, Justine.
Thank you, Karen. So next slide, please. So I'll be giving an overview of what it requires for an issuer to register their white paper when it comes to issuing a crypto asset other than an ART or an EMT, so basically a utility token. So if one wants to register or notify their white paper to issue a token, or if they want to admit their token, their utility token, to trading. So one of the first key considerations, of course, is the famous white paper. One must draft a white paper in line with MiCA. They must incorporate a company in a chosen EU member state, notify the competent authority of that member state that they would like to issue or admit a token to trading, receive the go-ahead from the competent authority to publish their white paper, and then proceed to raise from the public or admit the token to trading on a new trading venue. And it's also important to mention that the issuer must also notify the competent authority and publish information relating to marketing communications. So next slide, please. In terms of what information, what content is included in a white paper, this includes information about the offerer or the issuer seeking to raise or admit the token. So here we cannot just accept anonymous management or administrators or any meme or cartoon character like persons in white papers if one wants to validly raise or issue tokens from Europe. So anonymity is not an option anymore. It must include information about the trading platform in cases where a trading platform is the one issuing a token. So for example, how Binance will issue BNB, for example. Information about the related crypto assets project, any rights and obligations attached to the asset, information on the underlying technology, blockchain, smart contracts, wallets, etc. Highlight all the relevant risks associated to the token issuance, and also an ESG consideration, whereby the issuer has to also include any impacts of consensus mechanism used to issue the crypto asset. In terms of exclusion, so who is excluded from such white paper notification, there are some exemptions. So one would not need to notify the white paper if they are solely offering to qualified investors, so a minimum ticket size of 100K, if the offer is made to fewer than 150 persons per member state, if the total consideration of the offer does not exceed 1 million over a period of 12 months, if the crypto offered is free, so there is no fees involved, and also if the crypto asset has the right to be used in exchange for goods or services in a limited network of merchants, so in a closed loop environment. Now, it's important to note that if one wants to list their token on a trading venue in Europe, and it is issued after the regulation has entered into force and became applicable, they need to notify, register in a, so incorporate a company in a member state and notify their white paper to a competent authority. And in terms of if the regulation applies retrospectively, so what about all those tokens which were issued or admitted on the market before the regulation was entered into force? The regulation does not apply retrospectively. The reason for this is not to cause market disruption. So any tokens issued on the market before MiCA entered into force can continue to be issued and operate and be listed on trading venues. Slide, please. Now, there are some other important considerations when it comes to utility tokens and white papers. So all information must be clear, not be misleading, and be quite comprehensive in terms of the format, and make sure that it is in an easy and legible way to understand for retail investors. The language should be the English language or another member state language in addition to the English language. The white paper must contain various disclosures. It must also contain a statement that the white paper has not been approved by any competent authority. So here we're speaking about valid notification and not approval or licensing or anything like that. The white paper shall also contain assertions in relation to any future value. So you cannot say that the value is going to go up or down and promise of any sort of investment. It should also clearly state that the crypto asset can lose value in part or in full and may not always be liquid. and this is of course to protect retail investors. It should also contain a statement that the issuance is not covered by any EU investor compensation schemes. It should also contain a summary about the key characteristics of the crypto asset in order to help retail investors make an informed decision and know exactly what they are investing in. When it comes to safeguarding arrangements, it's important to know that the issuer must engage or choose a licensed credit institution to hold and store any assets when it comes to the fiat side, and must also engage or source an EU licensed custodian when it comes to the crypto assets. When it comes to any modifications made to the white paper or to the market communications, it's important that these are communicated to the competent authority and also updated on their website. And it's important that the issuer must timestamp the modifications and make available all the versions to the public. There's also an interesting new concept called the right of withdrawal, which is a sort of cooling off period. And this basically allows retail holders to have a period of 14 days in which they can withdraw from their investment, their agreement, and opt for a refund without giving any reasons. This is once again to protect retail investors in this market, which is quite nascent and sometimes targeted at young, naive, let's say, investors who end up losing a lot of money. And when it comes to liability, members of management or supervisory bodies will not be held liable unless there is proof of incorrect or misleading information within the white paper. Next slide, please. So that's it in terms of requirements for white papers for utility tokens. Now I'm going to move on to MiCA in terms of crypto asset service providers. So next slide, please. So the regulation is quite MiFID based. So those of you who are already operating in the market and are familiar with MiFID based rules will find the regulation quite easy to understand in terms of what is applicable and what are the requirements. Also, the licensing and the authorization rules is very similar to obtaining a license in any other industry. So, for example, if we're speaking of obtaining a broker license under MiFID or an EMI license under financial institutions, it's quite similar. Firstly, a CASPS must be a legal person established in an EU member state. It must have its registered office in the EU member state and must have a minimum amount of substance, local substance requirements, including at least one director who shall be resident in the Union. When it comes to passporting rules, this will apply the same in the same manner that it is applied to other industries, the same for crypto asset service providers. And in terms of what the authorization application pack should include, this includes the following. So obviously the name, the contact details, the address, website, and the legal form of the applicant, a program of operations or a business plan in terms of the type of crypto assets that the applicant intends to offer and market, a number of prudential safeguards, good governance arrangements. Due diligence will be carried out on the shareholders and management body, so they have to be competent, qualified persons, have to have a good track record, no history of fraud or insolvency, let's say. There has to be strong AML, risk and BCC considerations and policies, very strict systems and processes when it comes to IC security arrangements, especially obviously because we're dealing with technology here. A description for segregation of clients' funds. This is stressed throughout the regulation, and this is of course stemming from incidents which happened in the past, let's say with FTX and others, that there was no proper handling of clients' funds and no proper segregation. And then other policies such as complaints handling policies, outsourcing policies, and good governance related policies. When it comes to the technical standards, these are not yet published and finalized. but are being worked on, and the technical standards will basically contain a lot of important information which will be needed to complement these provisions. So on templates, on the applications, on various policies, etc. I want to speak about timeline when must authorities grant regulations. Here, Article 63 of MiCA states that competent authorities must within 5 days acknowledge receipt of an application. Within 25 days shall assess whether an application is complete or not. If an application is incomplete, give a deadline within which to provide further information. And then competent authorities have 40 days within a complete application to grant or refuse an applicant authorization. There are also some considerations in terms of if the applicant forms part of a group where there's another regulated entity within the group, and the regulation states that the competent authority shall consult the competent authority of the other member state in relation to the application submitted for the CASPS within the group. And there are also subsidiary or ancillary rules and regulations depending on what the service is being provided. So if we speak about custodians, for example, we have some concepts such as custody policy, specific custody agreements. One must keep a register of positions, and the register of positions must contain information such as balance, value, and transfer of crypto assets made throughout various reporting periods. They must submit quarterly reports to their clients. When it comes to liability, custodians can be held liable for any crypto losses, so income insurance over here, unless obviously it can be proved that the reason for the loss was not attributable to the provider being offering the services. So let's say it was related to some inherent issue with the distributed ledger technology. When it comes to trading venues, there are some ancillary regulations such as non-discriminatory rules, giving information on what the listing requirements are, what the suspension rules are. It also states that privacy points cannot be listed on trading venues. So let's say, for example, Monero. And an important concept is that trading venues must have very good systems in place to deal with large volumes and capacities and be able to operate under severe market stress. This once again due to incidents such as FTX, which happened in the last 2 years. When it comes to best execution, persons must have a best execution policy. And also when it comes to persons providing investment advice or portfolio management, there are certain additional considerations. For example, that the persons need to be approved for providing these specific services to ensure that they are competent to provide such advice or manage such portfolios. They need to conduct certain assessments such as client suitability and risk assessments before providing that advice or managing that portfolio. And some other supplementary rules depending on which service we are dealing with. There's also a new concept such as called the orderly winding down concept. So this basically states that all applicants must have an orderly winding down plan in place. And the purpose and the scope of this is to ensure that in case of the reason arises, so if the applicant becomes insolvent or there's a market crash, that clients and the market in general will not be harmed. Next slide, please. So that's a good overview in terms of crypto asset service providers, what is included in the application pack, timelines, supplementary conditions, etc. I will now hand over the floor to you, Kel, to cover how can investment firms, MiFID-related firms, leverage their license under MiCA.
Thank you. I think you can move to the previous slide, please. So here, exactly, how can investment firms leverage their license under MiCA? So an investment firm may provide crypto asset services in the European Union equivalent to the investment services and activities for which they are specifically authorized under MiFID. So if you can move to the next slide, please. So in this slide, you can clearly see here what is the MiCA activity type and what would be the MiFID equivalent of that service. So clearly, providing custody and administration of crypto assets on behalf of clients, that would be equivalent to an investment firm licensed and authorized to offer safekeeping and administration of financial instruments for the account of clients, including custodianship and related services. It's the same. The service, what you have to understand is that MiCA very much was drafted with MiFID in mind. It took a lot of things from MiFID, especially the licensable investment services. Many of the services are akin to one another. I mean, if you just go through the list, even exchange of crypto assets for funds and other crypto assets, that's dealing on own account. Execution of orders for crypto assets on behalf of clients, that's executing orders on behalf of clients. Portfolio management, investment advice. So what it's MiCA saying is if you're a MiFID firm and you're licensed to offer specific services, and they are akin to the crypto asset services, then you may also offer those crypto asset services. Please move to the next slide. So when would a MiFID investment firm be able to offer these crypto services? So MiCA will apply from the 30th December 2024, except for Titles 3 and 4 of MiCA that deal with EMTs and arts. Those apply from the 30th June 2024. Therefore, authorized MiFID firms would only be able to provide crypto asset services deemed equivalent to the MiFID activities for which they are already authorized once MiCA comes into force in December 2024, not before. Next slide, please. What information must investment firms provide when notifying its competent authority of their intention to engage in any activities involving crypto assets? So this is important. If you move to the next slide, there's the answer, I believe. So yes, Article 60 of MiCA sets out that the notification must include the following information: a 3-year program of operations, and anti-money laundering and countering the financing of terrorism framework, a description of the firm's information technology and communication systems, asset segregation policies, procedures and systems to detect market abuse, the type of crypto asset activities the firm intends to engage in, the risk associated with these activities, and the measures the firm will take to mitigate these risks. I mean, to delve a bit into some of these points, for example, a 3-year program of operations, what we're talking about here. So the type of crypto assets the firm plans to engage in, markets in which the firm plans to operate, services the firm's plan to offer, and resources the firm will allocate to its crypto asset activities. As for the AML-CFT framework, you need to provide detailed procedures on customer identification and verification, transaction monitoring procedures, risk assessment procedures. As for the ICT systems, the information they're looking for is information on your hardware and software systems, security measures, business continuity plan, asset segregation procedures. They're looking for procedures for the segregation of clients' assets funds, description of the approval, cryptographic keys, and safeguarding of cryptographic keys. And the list goes on and on. Next slide, please.
That's back to me. Thank you, Kerr. So in terms of transitory periods of MiCA, next slide, please. So as we all know, MiCA entered into force in June 2023. Stablecoin issuers need to be authorized by June 2024. We're currently in February, so unless a stablecoin issuer has submitted their license application, they might not make the deadline, and if this happens, they might need to cease operating until they obtain a license. And then all the rules apply in full to crypto asset service providers after the 30th December 2024. So they have till the end of the year. Next slide, please. Over here we have an 18-month implementation phase, and we have an 18-month transitional phase. So there are certain procedures which member states can opt to offer. So these include the simple authorization procedure and the grandfathering procedure. So between December 2024 and till July 2026, we are dealing with this transitional phase post MiCA entering into force. Member states can opt to implement and benefit from something called a simple authorization procedure, meaning that if a crypto asset service provider obtained their license in that member state by December 2024, they can get a MiCA compliant license in January 2025 and start passporting their services. Member states can also opt to implement the grandfathering procedure, which means that they can allow crypto asset service providers to continue operating in their member state for up to 12 to 18 months. On this point, ESMA is pushing for member states not to allow CASPS to continue operating further than the 12-month mark, but it is up to the various member states what they want to choose in terms of how many months to allow the grandfathering procedure to operate for. This can be between 12 and 18 months. So in terms of transitional periods, that is where we are, and that is where we're dealing with. We also have the RTSs, which should all be published by the end of this year, and which would be very, very helpful for regulators and also operators who are implementing and carrying out these rules, because they will provide some further clarity when it comes to provisions which perhaps are not so clear. Next slide, please. Now I'm going to talk a bit about the travel rule. So what is the travel rule, and by when do CASPS need to implement this famous travel rule? So in 2019, FATF, which is a global AML watchdog, published a recommendation which requires VASPs and financial institutions engaged in transferring virtual assets to collect and share personal data of sender and recipients of these crypto transactions, aka the famous travel rule. Now, the rule applies a threshold of €1,000 for transfers. However, transfer funds regulation, which is the European version of the travel rule, and which will start to apply together with MiCA CASP rules, so from December 2024, has removed the threshold for CASPs, this €1,000 threshold, unless they are talking about self-hosted wallets. So basically, all crypto asset service providers need to apply the travel rule regardless of amount. So the €1,000 threshold doesn't apply unless we are speaking about transactions to or from self-hosted wallets. So this €1,000 threshold will apply if there are transfers being received or sent to self-hosted wallets. As I said, this rule will apply to all financial institutions such as banks and all crypto asset service providers, and this dealing with the transfers of exchanging crypto to fiat, fiat to crypto, or crypto to crypto. Now, when it comes to pure DeFi, so transfers to and from self-hosted wallets, so from a self-hosted wallet to another self-hosted wallet, this will not be caught by the regulation, the transfers fund regulation, and therefore by the travel rule. Now, in terms of what information is being collected, when it comes to the originating crypto asset service provider, so the sending VASP, these need to identify their client, obtain certain information from their client, such as ID and address, retain and record the information, and then share the information with the beneficiary, the receiving CASP. And they also need to do checks and sanction screening on the name of the originator. When it comes to the beneficiary, so the receiving crypto asset service provider, they need to obtain this information from the originator and verify this information, and then also retain and record and sanction screen the name related to the crypto asset being transferred. As I said, transfers between self-hosted wallets do not apply, are not subject to this regulation, so pure DeFi is excluded over here. Now, in terms of technical challenges or implementation challenges, we have various challenges when it comes to the travel rule. Firstly, we have challenges when it comes to culture. So a lot of persons operating in crypto, especially in pure DeFi, do not have a culture of compliance. So they have a problem with AML and KYC, regardless if they are not doing anything for bad reasons. In fact, in this case in point, there was a non-custodial wallet called Trezor who tried to implement a verification procedure at the protocol level. However, all the users pushed back and said, if you implement this KYC measure to interact with exchanges, we will just start using another self-hosted wallet. And so they abandoned this implementation. However, it's just a matter of time. Once December 2024 comes, if any non-custodial wallets want to interact with regulated crypto asset service providers in Europe, they have no choice but to implement certain layers of verification. Another sort of issue, quite a big issue, is privacy concerns. And this stems from the fact that transactions are being recorded on the blockchain. So if we have some vulnerability or attack, it would be possible to reveal the whole financial history of an individual. However, on this point, there are solutions which are keeping customer privacy in mind in terms of complying with the TFR. So it's about finding the right solution and provider. Next slide, please. We have something called, I don't know if any of you have ever heard of it, the sunrise and sunset issue. So in some jurisdictions, the sun has risen, and in some jurisdictions, the sun has not risen, meaning that in some jurisdictions, they have implemented and enforced the travel rule, and in some, they don't. So what happens if I am operating in a jurisdiction where the travel rule is being implemented, let's say Switzerland or the UK, and I'm interacting with a CASP in another jurisdiction, let's say a European jurisdiction, who has not implemented the travel rule because they have since December 2024. How do I obtain this information? So this is quite a challenge in terms of complying with the regulations, depending on where you are and who you are interacting with. So according to a FATF survey, 35 out of 135 responding jurisdictions have passed the travel rule, and 27 jurisdictions have begun implementing enforcement in relation to the travel rule. So there's a big gap. Some have enforced, some have passed, some doesn't exist. And so it can take another 1 or 2 years for everyone to be on the same page when it comes to the travel rule. Now, last slide. Next slide, please. Thank you. So to conclude, when it comes to MiCA, there are some clear market leaders. There are a couple of jurisdictions, namely Malta and France, which did have MiCA akin sort of crypto frameworks, which are very similar to MiCA, also based on MiFID. So if you have to look at the Malta Virtual Financial Assets Framework, it is largely modeled on MiFID and is very, very similar in text to MiCA. I think there was only a 10% alignment with which the MFSA needed to make. So obviously when it comes to the MFSA granting authorizations, they are very used to this regulation, and they're actually quite excited for the MiCA transition, because they do have an advantage over many other jurisdictions who, let's say, only had AML or KYC registration. Also, France, I would say, is a competitor in terms of good jurisdictions which are already MiCA compliant, because they had a digital asset framework, which is also largely modeled on MiFID and very, very similar to MiCA. So we will see some regulatory arbitrage, and we will see some jurisdictions which will implement the regulation with ease. and there'll be less confusion or less mess in terms of the implementation stage. There will be some disruption, I think, across the board until the regulatory technical standards are fully published, and there is a challenge with implementing a regulation and granting an authorization in parallel to waiting for regulatory technical standards which provide more clarity to be published. So this overlap and all this happening in parallel will create some confusion. However, by the end of it, so 1 or 2 years time, everyone will be on the same page, have the same rules, and passporting will fully be in force. So that's it from us on the marketing crypto assets regulation. Hope it provided some good insights to all of you. We'll just leave a couple of minutes for questions. So perhaps I'm seeing in the chat, Kelly, would you like to take the first question from Jacob? What is the possibility rate of developing a global regulatory regime for cryptocurrency?
The possibility for that for the time being is presently very low because you have the EU moving in one direction, which is harmonizing and regulating crypto asset services. Then you have the US moving in the other direction, where they are outright at times banning crypto service providers from offering their services. And there's also a question from Mustafa, which I'd like to answer, where he said, would member state-based regulations be able to threaten the harmony of crypto EU-wide? And no, they will, to a certain extent, they won't, for the simple reason, this is why MiCA, the regulation, was approved, because it would harmonize the regulation of crypto services across the EU. And you know, the regulation is the foremost piece of EU law which can be approved, and because of that, member states have to abide by it. The regulation, it is even stronger than a directive. So if they don't abide by the MiCA, then they will open themselves up for very hefty fines.
All right, and I'll take the last question from Marco. So which jurisdiction would be best to get authorized as a crypto asset service provider? Well, I would say, obviously, maybe I'm slightly biased. However, it is also very genuine that Malta is probably the best jurisdiction to get authorized, because we've had a framework which is sort of exactly like MiCA in place for about 5 years. The MFSA is very competent, have a big technical team. So at least you know what to expect. And you know, they will obviously honor the timings, since they have experience in this aspect. France, as I said, is a competitor for Malta when it comes to granting authorizations because they have a similar regulation. However, from a tax perspective, probably Malta is a better jurisdiction of choice. So that's it from us. If you'd like to contact us for any reason, we have our email addresses and our website over here on the last page. And thank you, Mondaq team, for organizing and hosting the webinar. It was great.
Thank you, Justine. Thank you, Kelly. An incredibly informative webinar. Really appreciate your time, and also to our audience. And you can see Justine and Kelly's email addresses. Please do get in touch if you have any questions for them. Brilliant. Well, have a lovely rest of your day. Everyone, we look forward to seeing you again soon. Bye.
Thank you very much. Ciao, ciao.
Bye-bye. Thank you.